Good morning and welcome to our 15-minute webinar series brought to you by the BOMA Suburban Chicago Government Affairs Committee and Industrial Committee. I'm Michael Mulcrone, Executive Director at BOMA Suburban Chicago. On behalf of the Board of Directors, the Government Affairs Committee, and the Industrial Committees, thank you for taking time from your busy schedules to participate in this webinar. This webinar is being recorded and will be posted on the BOMA Suburban Chicago website and our YouTube channel as soon as we can download it. In addition, we will send the presentation to everyone who is registered. Because we only have 20 minutes and we have over 100 RSVPs, we will not be taking live questions. Please send your questions to me at michaelm@bomasuburbanchicago.com. Now let me introduce you to our speakers. Juan Arias and Joseph Biazzi from CoStar Advisory Services, coming to us today from Boston. Gentlemen.
Thanks, Michael. So thank you for taking the time to listen to our presentation. I don't think I need to tell anyone here that the economic situation across the world is fairly dire. Today, we're going to focus on a really vital piece of that global economy, the supply chain. The World Trade Organization is projecting a broad range of between 13 to 32% decline in world merchandise trade for 2020, indicating the high level of uncertainty around how this pandemic will play out. Though it seems this collapse will be worse than the Great Recession. Also, estimates for the recovery in trade in 2021 are equally uncertain. Predicting the trajectory of the recovery has been difficult, as changes in economic activity will move lockstep with the virus and corresponding lockdowns. We will not pretend to be epidemiologists here, so any forecasts or predictions we lay out assume a slow but steady return to normalcy. A resurgence in cases and lockdowns would cause our expectations for the economy to further deteriorate and lengthen any recovery. Looking domestically, we have seen the sharp drop in the movement of goods coming from U.S. shores. And we can see this both in the drop in number of TEUs moving through the ports, as well as the slowdown in U.S. rail and trucking activity. At first, the deceleration in imports was most noticeable in Western U.S. ports, as these have a higher exposure to Chinese exports. But we are now also beginning to see a slowdown in imports through Eastern ports, which have a higher exposure to European and other exporters. The overall slowdown in imports, originally driven by manufacturing shutdowns, is now set to be prolonged by decreased consumption, as U.S. consumers now face a recession. Additionally, lockdowns around the country have slowed the movement of non-essential items in the economy, with U.S. trucking activity falling sharply, as indicated by load-to-truck ratios dropping around 50% in early April. Since China's manufacturing shutdown in the first few months of the year, we have continued to see demand for shipping decrease significantly. A look at monthly blank sailings or canceled container ship sailings for the month for major shippers shows the extent of the demand drop. The total number of blank sailings has dropped since April, but as a share of total sailings, blank sailings have continued to rise. This is due to the number of actual sailings also falling in May. Major shipping lines have decided to scrap certain scheduled ship departures, as large amounts of canceled shipments, mainly driven by decreased demand for non-essential items, make voyages of these large container ships unprofitable. Recent surveys of major 3PL firms underscore these trends. Around 60% of third-party logistics providers and other shipping firms say their operations have been significantly impacted by the slowdown in activity. Over 70% of respondents that have been impacted indicate the main impact was driven by declines in freight volume demand, with 60% experiencing some sort of transit delay. Around 1/3 of those impacted have responded by shutting down their supply chains. Others have delayed their shipment delivery schedules. 3PLs have seen a big spike in some flow-through product that typically would be forecasted to sit in the warehouse. Customers like Kroger, home gardener suppliers, keyboards, etc., are now pushing 3PL tenants at over 200 to 500% above forecast as consumers' demand preferences have shifted. Most survey respondents expected a long and slow recovery. This matches certain CoStar Advisory research CoStar Advisory Services has been conducting, which suggests a U-shape or a swoosh recovery. This sudden and unprecedented shock to supply chains has driven many 3PLs to rethink the way they can conduct business. 40% of respondents now plan to make changes to their operations, with the main investment expected to be in technology improvements. 3PLs have realized they needed better technology to be able to have more visibility over their supply chains in order to make them more flexible to sudden changes in demand. As for inventories, most companies have already said they plan to decrease inventories over the next 3 to 6 months. Consumption is a leading indicator for inventory levels, and the first quarter of 2020 saw one of the worst quarters for consumption declines in US history, with the second quarter expected to be record-breaking. We expect inventories will decline along with consumption. We do not expect companies to change their supply chain management strategy to one of increased inventories, at least long-term. The pandemic is a black swan event, meaning while firms will now take the possibility of a global pandemic into consideration and make changes to problem areas that have been exposed, such as an over-reliance on China, most will likely not give up cost-saving measures like lean manufacturing and just-in-time inventory management that were working pre-crisis. Low-margin products using just-in-time are getting burned by shortages, but these are still cost-saving measures that help direct resources to where demand is. While right now using these strategies is a negative, in a post-COVID world where demand is depressed, cost-saving is going to be important. Instead, look for firms to begin to wield more control over their supply lines and invest in technology for better oversight. So just to sum up and make a few last points on the supply chain, generally, the bottlenecks that many US ports were expecting in March have not materialized, with a few exceptions like the Port of Jacksonville, which has had to work with nearby warehouse operators to store shipments with companies who were unable to cancel in advance, and now have to store these away as consumer demand has dried up. Still, the major US ports of LA and New York, New Jersey continue to see a normal flow of goods, partly aided by the large amounts of canceled shipments. Shipping lines have also had to innovate by securing container storage space for customers and transshipment hubs, and are now discussing dynamic pricing strategies to maximize loads in each of their sailings. Historically, bottlenecks in the US have been mainly driven by a shortage of truckers. A lack of truckers was already an issue facing logistics industry in the past cycle, and we expect this crisis will accelerate demand for autonomous trucking. More broadly, we expect firms to innovate and wield more control over their supply chain, as opposed to holding more inventory in the long run. If firms post-COVID want a more agile supply chain, holding on to more inventory is likely not a very good solution. While it's true that many using just-in-time strategies suffered in the crisis, as we said before, we expect them to invest in ways that keep the cost-saving structure of the strategy, while also creating a more robust supply chain. That could be in the form of better technology for tracking or diversification of sourcing and production through reshoring. Speaking as broadly as we are, there's no one-size-fits-all approach, but look for firms to reevaluate their supply chain risk factors and bottlenecks post-crisis and make changes accordingly. I'll now turn it over to Juan Arias to discuss what that will mean for the industrial market. Juan?
Thanks, Joey. So we still expect positive absorption of US logistics space in 2020 of around 40 million square feet. This significantly low absorption level will still not be enough to keep overall vacancies from rising. A significant wave of supply is set to fuel this rise in vacancies, though supply delays may soften the blow as we continue to see major players like Prologis deciding to stop all new speculative projects and some build-to-suits around the world. We still expect vacancies to rise, though, to a range of between 6 to 8% in the next 2 years, as slower overall demand coincides with this rise in supply. This will result in slower rent gains for industrial properties, though the slowdown may be mostly concentrated in larger distribution facilities, which are mainly impacted by the supply risk. One tailwind for fundamentals is the fact that construction delays and cancellations are beginning to rise, so the expected wave of industrial supply may not materialize to its full extent. Contractors have seen a rise in project cancellations, along with a rise in shortages of materials, workers, and now personal protective equipment required in construction sites. Despite this slowdown in construction, we still expect a significant contraction in industrial demand. The baseline scenario is now forecasting the loss of approximately 6 million square feet of industrial demand in Chicago for 2020, and construction has largely continued in the metro. There is approximately 17.2 million square feet of space currently under construction, and over half of Chicago's under construction industrial space is still available for lease. With demand formation largely hampered in the near term, industrial fundamentals are expected to face both supply and demand side pressure into 2021. While economic shocks resulting from the coronavirus pandemic are expected to put pressure on industrial demand in the near term, the commencement of 4 1 million square foot plus leases will help soften the near-term blow and support absorption through 2020. 2 of these leases were signed by Amazon, including their future 1.1 million square foot facility in Channahon, a community just southwest of Joliet, which is near 2 major interstates and the Up Joliet Intermodal Terminal. Proximity to intermodal terminals has been very attractive for tenants in the last cycle, and we expect we have reached the bottom in intermodal rail activity over the last few weeks, with intermodal container loads bottoming in mid-April and regaining some ground in the last 2 weeks of the month. Despite this, we expect the dispersal of supply chains to be a drag on intermodal demand in the coming years. Slower demand is expected in those sectors where we expect to see trade fall steeply, such as industries with more complex value chain linkages, like the aviation and automotive sectors. These industries, along with retail, leisure, hospitality, and energy, are now at risk of significant contraction. Metros like Detroit and Seattle, with a high tenant exposure to the automotive and aviation sectors, are likely to see a more pronounced slowdown in industrial demand. Metros like Oklahoma City and Houston, with high tenant exposure to the energy sector, which is facing some of the lowest oil prices seen in over 20 years, will also likely see a softening in industrial fundamentals. Other metros like Minneapolis and Miami, with high exposure to brick and mortar retail tenants, are also at risk. And metros like Atlanta, Orlando, and Las Vegas, with high exposures to leisure and hospitality tenants, will also face headwinds in the coming year or two as world travel remains subdued. Overall, the metros which already had significant speculative development and are now facing major medium to long-term economic headwinds stand to lose. Oklahoma City, Detroit, Houston, Las Vegas, and Orlando really stand out here, as these metros already had significant speculative development, and the major industries of these cities may take longer to recuperate. Chicago's GDP is expected to be impacted by the slowdown in the manufacturing sector, the largest component of GDP in the metro, while the professional, scientific, technical services, along with the healthcare industry, third and sixth largest share of GDP respectively, should help soften the blow. In fact, Chicago has over 20 million square feet of industrial space dedicated to biotech and medical equipment manufacturing tenants, one of the largest footprints in the nation. Despite these near-term challenges, industrial properties are set to perform the best during this crisis. The overall significance of manufacturing and retail tenants as a source of demand has decreased over the years, while e-commerce, which is proving resilient during this crisis, has continued to rise. In fact, e-commerce retailers were the main source of demand for logistics space in the last cycle, and we expect them to remain so in the next. So far in 2020, we have seen e-commerce tenants continue to be the main drivers of absorption, taking over 13 million square feet of space, followed by home centers and transportation tenants. Before the pandemic, we had already projected e-commerce would need an additional 400 million square feet of space in the coming years. It may now need even more space and sooner. In Chicago, Amazon has already signed on to fill more than 3 million square feet of space in 2020, which will increase their local footprint to over 11 million square feet spread over 28 spaces. In the US, absorption has been favoring smaller properties so far this year. Leasing for larger properties with more than 75,000 square feet has slowed significantly since the beginning of the year. As of April, these properties saw leasing volumes of less than 30% of the normal historical average level since 2016. Since the start of 2020, we have seen leasing trends holding up better for these smaller industrial assets. As of April, industrial assets between 5,000 to 20,000 square feet were seeing leasing volumes of 40% of the normal historical average level since 2016. In Chicago, properties of less than 150,000 square feet have seen significant demand and little to no supply additions since 2010, while mid-sized properties between 150,000 to 400,000 square feet, along with larger properties, continue to see supply risk. Strong absorption of smaller assets is partly driven by the continued demand for last-mile space. Many e-commerce providers have realized that their delivery platforms are still ill-equipped to handle surges in demand and consumer expectations for fast order fulfillment. This unexpected surge in demand for e-commerce in the last few months has resulted in a slowdown in order fulfillment times. This has forced players like Amazon to move quickly to shore up their last-mile capabilities by hiring around 100,000 workers, many of which will be used for last-mile delivery. Amazon is now in the process of hiring 75,000 additional workers. Since 2015, as Amazon began announcing faster delivery operations, we have seen an uptick in absorption of smaller properties by the e-commerce provider, as it continued to improve delivery times by locating in smaller infill properties closer to final consumers. In 2019, the majority of these properties Amazon occupied were of less than 250,000 square feet in size. And so far in 2020, we have seen a similar trend. Strong demand for last mile space will continue to benefit industrial fundamentals in metros which justify such a strategy. Metros with significant populations as well as high income levels are set to benefit. Chicago, with a 10 million resident population, along with metros with above average consumer buying power like major core coastal metros, as well as some high growth southern markets, are well placed to attract last mile demand. But what types of last mile properties will be in high demand? Well, for that, we must look at changes in online consumer spending behavior during these lockdowns. When looking at what items have sold online in the month of March, we can see that the majority are healthcare and food items. Healthcare items are largely driven by the healthcare crisis we're currently facing, but we expect the demand for online food purchases to continue even after the crisis has ended. The strong March grocery retail sales reading, showing a monthly surge of 30% in sales, was originally partly driven by panic buying, but we expect this surge in grocery sales is here to stay as at-home cooking increasingly becomes the norm for many households. Due to the significant number of restaurants which now face prolonged closure or constrained seating capacity, we expect the crisis to cause many food service businesses to disappear. We expect people will continue to be scared to go into crowded venues in the coming months as well, and the increased economic stress will force many to continue to cook at home. The demand for groceries will continue to boost online grocery sales as well, with the share of household buying groceries online increasing sharply to over 30% in March. This surge in online grocery delivery and pickup continued into April, with sales increasing another 37%, even after the March surge. And the number of orders, as well as frequency of orders, continue to increase significantly. Online grocery providers, including Amazon, have been overwhelmed with this surge in demand, causing delivery delays. This demand surge will drive online grocery providers to continue to improve their delivery platforms with an accelerated adoption of highly automated micro-fulfillment centers. These centers will offer a mix of delivery and in-store pickup in order to serve various customer needs. We have already seen players like Walmart, Kroger, Sedanos, and Tesco in the UK begin investing in this layout. The shift from restaurant dining to at-home cooking has resulted in significant strain to the food supply chain, as many of the foods that are packaged in bulk for sales to restaurants cannot easily be converted to serve grocery stores. Food suppliers, and specifically meat packing plants, have been making changes to their manufacturing operations in the last few months, and as these short-term challenges are overcome, we will see an improvement in food distribution. Meat packers have been adding plexiglass screens to divide workspaces, are providing face masks, and performing temperature checks on workers, like in Cargill's plants. Despite these changes, analysts still expect a 15% reduction in meat production throughout the year as workers continue to get sick. This may push meat packers to invest in robotics in the coming years. The good news is that the US food supply is highly self-reliant, with a population generally close to the food producers, and as these issues are resolved, the continued increase in grocery shopping will benefit another slice of the industrial market as well. The increase in grocery demand, along with sales of packaged frozen foods, which can be stored for longer, is evident in the increase in refrigerated trucking demand over the last few weeks, with load-to-truck ratios increasing sharply for this sector of trucking versus all others, as indicated by the light blue bar on the far right of the chart. We believe the lack of usable cold storage space or actual freezer space, which has been evident since 2009, when many smaller providers went under, coupled with the increased demand for groceries, will provide a strong tailwind for cold storage space demand in the coming years. The high costs and complexity of building out this kind of space will continue to place constraints on supply, but savvy real estate investors who can figure out a cold storage investment strategy, or developers who can execute projects in the coming years, stand to benefit. CoStar Advisory Services is here to help, and we'll be releasing a cold storage white paper with more in-depth analysis to clients in the coming months. In sum, we have seen a dramatic slowdown in the flow of goods across the economy, with significant impacts to supply chains. But shippers and 3PLs are adapting, and investments in technology going forward will make supply chains more flexible to such drastic changes to demand and supply. Winners from this crisis will be those e-commerce platforms that are fast to adapt their supply chains and online grocery providers that invest in improved delivery and in-store pickup services. We expect overall industrial demand to slow, specifically for larger bulk assets, which are also impacted by significant supply risk, though supply delays should mitigate this impact. We also see the shifts in consumer behavior, specifically in the grocery space, providing a strong tailwind for last mile and cold storage space demand throughout the nation and Chicago as well. With that, we have come to an end of our prepared remarks, and I'll hand it back to Michael for any closing comments.
Hey, gentlemen. So one of the questions that came up was in terms of the U-shaped recovery. So where are we at in terms of the U-shaped recovery?
I'll take this one. I would say we're still probably declining. You know, states are opening up, but there's some evidence that people are still pretty nervous to go outside and do any unnecessary activities, such as go to a restaurant. I would say we're close probably to the bottom. The second quarter is expected to be the bottom, and then we should start to see the recovery. But a U-shaped recovery implies that it will be 2021 at best before we return to trend growth.
Okay. And then just a real quick definition of a black swan event. What is that?
So black swan event is, it's something that doesn't, you wouldn't expect to see very often. I would say this pandemic is a 1 in 100-year event. It's something that you don't spend a ton of money preparing for, but now, given that it's happened, you do have it in the back of your mind as something that you need to prepare for. Realistically, what this does is expose a lot of firms' supply chain vulnerabilities. You know, we've looked a lot at people concentrating too much on China, for example, and a lot of companies are considering diversifying their supply chain away from China, keeping some of it in China, but also maybe moving to Vietnam or to Taiwan to ensure some more stability if there's problems.
Great, thank you. So thanks, guys. I really appreciate you jumping on this so quickly. Again, if you have any questions, please send them to me at michael.m@BOMASuburbanChicago.com. Thank you again. Watch your emails for our next 15-minute webinar. I hope you have a good day.